David Barrett is CEO of EBC Financial Group, the award-winning liquidity provider for institutional and professional traders. David, we've spoken about the impact of rising interest rates on the market generally. How is it affecting derivatives specifically?
If you look at the market in general, you could argue on the surface that not a lot has changed. But I think if you dig a little deeper, I think that's not true. I think the fallout, particularly in, say, the banking sector in the US, the regulator has heightened its approach and it's heightened its scrutiny of what's going on. Only recently, the US has launched more stringent capital and reserve rules based around what happened to the 3 regional banks earlier in the year. I think regulators in general are being more circumspect about what's going on with companies within their industry's balance sheets. We're regulated by the FCA in the UK. I've worked for regulated companies for 30 years and I've never seen so much introspection on the financial resources and how you manage those resources. I think liquidity providers are being a little bit more cautious about liquidity in terms of the leverage that they're offering. And I think, there's no doubt that the depth of liquidity when the market picks up pockets of volatility is a lot less than it would normally be. And I think that tends to be a fallout of the previous instances of pain that we've seen in the markets.
Any advice you can offer to traders in this new environment?
I think you've got to accept that the way that the market is functioning has changed somewhat. So whereas people would broadly be bullish on certain parts of the market, let's say stock markets, indices have been a very acceptable way of reflecting your opinion of what the market's doing. I think we are coming much more into a stock picker's market. I think you have to appreciate the state of a company's balance sheet, its liquidity and its ability to get through times of stress much more now than before. I think leverage should be reduced because I do believe that volatility has been suppressed for so long that we're getting to a point where that could easily change. Historically, interest rate differential have been a big driver in FX because everything's been homogenized to a very low level. Then we've had very low realized volatility in FX, and that's just starting to change. And you can see dollar yen's moved significantly over the past 12 months or so. That's mainly driven by an interest rate differential because the Bank of Japan's pretty much the only central bank that's not gone the rate hikes of everybody else. So I think people need to be more cautious with less leverage. I think they need to be more circumspect about what they're actually trading. And I think you should be aware of heightened volatility and what it does. Markets have very much mean reverted over the past 2 or 3 years. And I suspect that if we start to get trends in markets, they may keep going more than they have done.
And how about regulators? Would you recommend any changes or do you foresee them making any?
I think the regulator is becoming much better at appreciating how the market works. I mean, if you look at brokerage, which is what we do, their appreciation of how the sector works, how it makes its money, how that impacts on the end user is much better than it's been ever. So the UK FCA are just about to bring in a consumer duty package, which is there to heighten people that are selling financial products and their impact on their clients to the firms that are doing that. And I think that kind of deep dive and circumspect pressure will continue from regulators all over the world. There will be a lot more pressure for clarity of what you're doing, how you're offering it, and how it impacts the end user.
Thanks for watching. Learn more at ebc.com. Click now for more from this interview with David Barrett, and please subscribe for the latest international business insights from worldfinance.com.